Proper position sizing is the difference between becoming a consistently profitable trader and blowing up your accounts. After 11 years in the markets and generating over $11 million of profits, I can tell you that most traders don't fail because of bad entries. They fail because of poor position sizing. Today, I'm breaking down the exact position sizing framework I use every single day in my trading. This is the exact approach I use to grow small accounts and turning them into six figures without blowing them up. The biggest mistake I see traders make is they use the same exact position size in all their trades. And this drives me insane. But don't worry, I used to make the same mistake when I first started trading. Then I actually understood that you should have something that I personally like to call dynamic risk sizing. I size my trades based on the quality of my setups. We all know that not all setups are created equal. Not all of your entries are the same. So why are we risking the same amount if we have an A+ setup or a C setup? Imagine we're playing a game of poker. You have pocket aces and I have a 3 and a 4. And we're both putting into our pot $1,000. Who do you think has the higher likelihood of winning? The guy that has pocket aces. You should approach your trading the same way. If you're dealt a bad trade or just not proper position sizing or not proper PA, why are you betting the same amount as you would when you have a really good setup, when the price action has been really clean and easy for you to read? Those are the setups and A+ setups where you should be betting heavier. Put the chips on the table when there is the highest probability of you having a good trade. We have to understand that the market changes every single day. And if you've been trading for any period of time, you can agree with me and understand that certain days almost feel easier than other days. So you need to base and learn how to adjust your position sizing to maximize the days that feel easy, the days where you can read the price action, because it is most likely that you're gonna win much bigger. What I used to do, I used to use the same size regardless of market conditions. If we had big news or we had no news on that day, regardless of the setup, regardless of my own emotions on how I was going into the day. And this was causing me to just lose money. My wins were too small and my losses were too big. Why? Because on the bad setups or on the good setups, I was trading the same amount and it was ruining my risk to reward. The market doesn't give you the same quality setups every single day. So your position sizing should not be the same every single day and every single trade. Here's the framework that I used in my dynamic risk management strategy. For a standard setup, I use a base 1% of risk of my overall account. While for a perfect setup, when everything aligns, when I have an SMT, have a really clean liquidity sweep of equal lows, equal highs, have a golden pocket retracement, I have a fair value gap, and I have a tight risk with a really clear profit target, I'm gonna scale up 2 to 3, sometimes even 5% of my account size. Now, do understand this about risking a percent of your account. If you're trading on a small account, a live account that's $1,000, you're gonna have to move those numbers from risking 5 to potentially 7 to 8% just because your account size is not that big. But if you're trading on a prop firm, a $150,000 account, you can copy these numbers or you can adjust them depending on the drawdown that your prop firm uses. For example, some prop firms use 3% if you're trading futures, some use 8 to 10% if you're trading Forex. So adjust this based on the drawdown that you have on your account. Now, when conditions are unfavorable or they're choppy or the range is really small, I like to cut down my position sizing to risk to 0.5%. This helps me that if I know a trade setup might not be my might not be my bread and butter, I'm missing some key confluences in it. If I do lose on that trade, it's gonna be a much lesser loss and it lets me trade a little bit more aggressive during market choppy conditions where like I'm entering trade, I get stopped out, I'm not down 1% over in the day. I'm only down 0.5%. This gives me more buffer for the day and hold off my daily loss limit of 1.5% I have on the day to keep trading and try to make the 0.5% back and flip green on the day. You have to understand that the dynamic approach that I use is accomplishing two things that are really key to maximize your risk management. One is during choppy conditions where I'm not getting proper setups, I am lowering my risks. While when I am doing well, when I see the A+ setups, when I see really good conditions, really good weeks of trading, I'm maximizing those gains. Because trading is not all about understanding the setups, But trading, the number one thing that you have or that you are as a trader is a risk manager. The number one thing you need to worry about while you're trading is like, hey, this is my account size, this is the money that I have. How can I make the best out of risking as little as possible while maximizing my returns? That's your job number one. Doesn't matter what you're trading. Doesn't matter if you're trading EMAs, trend lines, ICT, BGC concept, it does not matter. All traders at the end of the day, number one, they're risk managers, and number two, they become traders. You have to imagine yourself as like, hey, you have this pot of money, how can you maximize returns while risking as little as possible? This is why dynamic risk management is just so important. There's been many studies done by different hedge funds proving that the best hedge funds around the world would bet really, really heavy when they had their beautiful A+ setup, and would bet much smaller on a riskier trade or riskier investment for them. So I took that mindset that I learned reading some studies, watching different people that I learned from, and I said, how can I apply this into my day trading every single day? And if you're in my trading group, when you trade live with me every day, I don't just say, hey, I'm longing in Q, shorting yes. I'm always adding to every single trade, what is my position size? Hey, I'm taking a regular size trade. Hey, I'm taking a heavy trade. Hey, I'm taking a half trade. Hey, I'm adding to my positions. Because I don't want to just teach people exactly just the setups. I also need to teach them how to manage their risk and how to maximize those profits, how to hold your winners longer, how to cut your losers quick. This is when I'm able to turn the traders from break even to losers to winning traders that are consistently making money and getting payouts every single week out of the markets. I don't want to just teach you, hey, this is a fair value gap or this is a basic setup. That's just not good enough to make it in this game. Let's talk about now the scaling trap. Another common mistake that I see every single time with beginner traders, that as soon as they start seeing a little bit of profits, a little bit of consistency in their trading, they're quick to wanting to scale up their position sizing, and this kills them. Traders that have a good month, a good week, they're able to even double their account. They're like, you know what, I'm killing it. Let me double or even triple my position sizing so I'll be able to make even more money. They fail to understand that growth is gradual. Let me ask you this. Let's say you have a $1,000 account. In a week, you're able to flip it to $2,000. Now you can trade with double the size, 100% more than the week prior. Do you think you could become a 2 times better trader within a week? No, of course not. So why are we doubling our position sizing if our trading isn't improved 2 times as much? One of the rules that I have is I tell people that once they're able to double their account, to withdraw it. I don't want to see the trader, just because they were able to make some money, now up their position sizing, because I know emotionally they're not ready to handle that P&L's doubling. They're not able to see from negative $100 a day, then they're seeing negative 200, negative 300, where they go back to their emotional trader self and those demons come back out and they're holding their losers too long, they're cutting their wins too early, and they start making all those mistakes that we're doing before they're turning profitable. Why? Because the emotional stress has just risen so much. We have to understand there is no rush to oversize our trades to grow our portfolio exponentially. The market will always be there, and you don't want to blow yourself up by taking on too much risk. One of the rules that I have is you need at least a 100 trade sample size of profitability before scaling up your trading. And the way I personally like to scale up is only by 10 to 20% max on your overall portfolio size that showed you that over 100 trades you were profitable. And I'm not talking about 100 paper trades, backtesting trades, those don't count. I'm talking about 100 trades that you took on a live account or on a prop firm account that you were able to get payouts from. Let's talk about the home run fallacy. So many traders out there, and I used to make this mistake as well, they go all in because they say, oh my god, this setup I just cannot miss. This is the one trade that's finally gonna take me out of the trenches. This is the one trade that's finally gonna retire me and all my family, without failing to understand that, hey, that does not exist. We recently had a day that the market went up 12%. Insane day. A lot of traders felt the FOMO of that just mooning on up, or they were in complete denial, like the market is up too much, I need to full pour my account short because it's bound to go down. They fall victim of this fallacy that they think one home run trade can change their life. But in reality, they are falling trap of the get rich quick scheme mindset that they think trading is. Well, no, a proper setup will always give you a proper entry. You never need to feel FOMO. There's not gonna be a trade that's gonna change your life, but it could be a trade that could ruin your trading career if you blow up your account. The number one way that traders are quitting is because they run out of money, right? It makes sense. They have an account, they blow it up, that was their savings, and they give up trading. So they're cutting their trading career short just because they have this mindset that they want to go all in. They're like, you know what? They feel like they're gambling. They want to go all in on black, all in on red, and they just want to catch that one huge winner because they see somebody on Twitter that potentially caught it. But guess what? That same guy you saw on Twitter missed the last 10,000 perfect setups. Your time will come, you will catch a home run trade at some point, but the only way you can catch it if you consistently show up to the markets, you catch your A+ setups, and you let that trade come to you. This is what I do. I'm not looking to catch home run trades because I know a home run trade will catch me. I'll be in a trade that'll be near the bottom or the top of a certain trend, and I'll be able to ride that all the way down. Now, it doesn't mean I'm chasing it, I'm letting it come to me. I'm being patient, and I just know my time is coming. I used to make this exact same mistake when I first started trading. There was one time where I was trading with a friend of mine, and this was in 2016, pretty early in my trading career. But we said, hey, Trump was gonna become president. We're going to war for sure. I'm like, this is a guaranteed, right? The chart looked good, everything looked good. I put my whole, which at the time was a pretty small amount of money, into my options account and bought option calls on war-related stocks that made missiles. But guess what? I was completely wrong. I had the home run mentality. I was trying to catch one winner that was gonna 20x my account, and I lost it all. So trust me when I tell you these things, I'm only teaching you what I had to learn the hard way. So you don't have to make the same mistakes I made, and you become profitable much faster than myself. Always remember, no single strategy has a 100% win rate. So I never risk more than 3% of my account on any given trade. I can have every confluence in the world. I can have Trump tweet exactly what I want him to tweet because I'm gonna go long and he's gonna cut tariffs. It does not matter. I'm only risking 3% max because I know it doesn't matter what, there's no trade that can confirm 100% win rate every single time. Let's talk about how to position size when you're in recovery mode. When you're drawdown and you're like, man, I just need to maybe up my position size so I can make back my losses. Just comment down below, do you think that was the other point? Because I know everybody is guilty of this. You're down on the day, you're down on the week, on the month. You're like, you know what, I'm just gonna start going really heavy so I can make back the losses much faster and try to make back my account. The funny part is this is exactly when you should do the opposite. My rule when I'm in drawdown of 5% or more on my whole account is one, cut my position sizing in half on everything. So an A+ setup drops down to 1%, regular setup to 0.5%, and bad setup to 0.25%. Why? Because I'm digging myself a hole deeper and deeper, and the number one thing I need right now is not actually the money to recover it, but I need the confidence back to understand my trading works, and I need to get some wins to finally kind of crawl myself back that if I see a $10,000 loss, I'm like, hey, it's only $8,000 loss, $6,000 loss. The hole doesn't feel as big as it really is, and I can slowly work my way back up. While most traders, they see a big hole, they're like, let me swing to the fences with one trade and just blow themselves up. No, again, the market is always there. You need to have the patience and you need to have the resilience that you're like, it's okay if I'm in drawdown, because over the long period of time, my strategy will get me back into the green. You need to have faith in yourself and faith in what you know, and your strategy that you've proven to be profitable up to that point can turn back green. There's been many hedge funds out there that use strategies that put him in drawdown for some period of time through the year. One of the best traders I knew, Lance Breslin, had a $30 million year, roughly. And during that year, he was in drawdown for about 10% before he ended up profiting $30 million. So I believe it was from January to February, he was in a 10% drawdown during that period of time. He could have easily blown himself up, lost all his money, but rather he stuck to his system. He knew that the system will turn it around because he had been trading for so long, and in the end, it worked out really, really good for him. Now, when I lower my position sizing, I wait for 5 profitable days to turn it back up. If after days I say, hey, trading back to how I always trade, I'm calm, cool, collected, waiting for proper setups, I'm not emotional, then I dial it back up and I'm back to my normal position sizing before I'm in the total drawdown and recovery mode. The compounding effect is how your account actually grows. People think that your account grows off of one huge winner, you're able to catch something that just 10x's your account. The truth is, your account will grow a lot of times without you even noticing. You're compounding the small wins and the good trades you're taking over time, and by the end of the month, you're like, wow, I made this much money. I didn't even notice it because you're only focused on the trades and finding proper setups. You're not focused on the money. But when you're focused on checking your account every single day, oh, I need to make X amount a day, that's when you start losing money. Let me tell you a study that they did. They gave two group of traders, Group A and Group B, two different goals. Group A was told to make $200 a day for 30 days, while Group B was just told, hey, trade, the money doesn't matter, you'll check it out in a month. Guess who was more profitable at the end of the month? Group A or Group B? Comment down below because I'm really curious on what you guys think. While Group B was far more profitable and had a much total net P&L than all of Group A. Why? Because when you set a monetary goal of your trading, you stop focusing on the trades, but you're focusing on the money. You're focusing, oh, I gotta make 200 bucks for the day. If I don't, I'm a loser, right? If I don't, I can't pay the bills. Those traders were so focused on the money that they second guessed their trading and they put it in the back burn and they were blowing up their accounts. They weren't profitable. They were profitable very slightly versus Group B. They ended up doing much better because they couldn't even see the P&L. They didn't care about the P&L. They were just looking for a couple good trades a day, go on about a day, being really stress-free. By preserving capital during periods of drawdown, it is when your account grows the most rapidly. And using dynamic risk management can help you scale your trading. Let me give you an example. You have trader 1 that is always risking 1% on a 1 to 2 risk reward, but has a 60% win rate. He will have roughly a 40% annual growth based on the stats. But if you can risk 2% on the A+ trade, he could roughly return up to 95% on the year. More than double the initial return, just making a simple switch of not using the same risk parameters for every trade, but raising the risk when he has a really high probability setups that's 80% or more. Now, what is the catch? Of course, it's not always going to be pros, but the catch is that if you do risk a little more, the drawdown could also be a tad bit more. But this is why I'm scaling my risk based on the setup, not just because I'm ready to risk more. Okay, now let's get serious and let's talk about practical implementation, how you can implement exactly what I talked about thus far into your trading. Now, establish a basic risk parameter that you want for your average trades. For most traders, I recommend doing 1%. Again, you will have to adjust this based on 1, if your portfolio size is really small, or 2, if your drawdown on your futures account is also really small and you want to risk it. Step 2 is create a clear setup. So understand all the trades that you typically take, whether it's continuation, reversal, golden pocket trade, write them down and give them a grade based on 1, risk reward on average, and 2, win rate. Now, based on the grade, assign how many contracts or your position size should be based on percent to each setup. So then now you have a plan to attack when you're going to the markets. If you can recognize, hey, this is my B setup, I'm just gonna risk 1%. If this, hey, my A+ setup, I'm gonna risk 2%. Hey, if this typically is my C setup, the one that works a little bit least, I'm gonna risk 0.5%. If you're not actually doing this exercise, you cannot apply dynamic risk management to grow your account. Step 3, define your conditions of your risk parameters. Is it choppy conditions? Is it you're in a period of drawdown? Is it too volatile? Because some traders like to up their size, to have a decent size when they're trading, and too much volatility can be too much of a risk for them to risk 1% and they gotta lower it to 0.5. To give you an example, if you have a $200,000 account and you typically risk 4 to 5 minis, but now the risks has been much bigger because the markets are much more volatile, that might be a reason for you to lower your position size. Number 4 is you need to document every trade. Document what was the position risk that you took, what was the outcome, and why you took that trade, so you can always fine-tune and better make use of the dynamic risk management strategies that I'm teaching you. Step number 5 is review monthly, and if you can, review weekly as well. Adjust anything you need to do, see what was your performance, what was your overview, and what was the outcome of that month. Did you actually use the position size correctly? Did you fall victim for trying to catch a home run? Did you fall victim of being in drawdown for some period, and did you use the proper system to get you back out of that drawdown and back into green waves. The key in consistency is really boring, which is discipline. You should be following your position sizing based on rules that you've written down. You should not be trading position sizing based on emotions. There is no need for emotions in professional trading when you're looking if you're taking a proper setup and how you're sizing into that proper setup. Follow them religiously and make it part of your trading plan every single day. Always tell yourself you're a risk manager first and you're a trader second. Position sizing is not the sexiest topic in trading, but it is extremely important and is the difference between long-term success or blowing up your accounts very quickly. The framework I laid out for you today has helped me survive over 11 years of trading and all kind of crazy market conditions. If you want to see how I apply these position sizing principles in real time, you can click the link in the description below to inquire about my mentorship. Thanks for watching, and I'll see you in the next one.